Tuesday, June 8th, 2021, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at how one of the top fund managers of the last 50 years is favoring metals and energy or resource equities in this age of inflation. I guess we can admit now that we are seeing a continued rise in consumer prices. Of course, inflation is the creation of money and credit out of thin air. When it gets out of the paper assets of general stocks and bonds into services, consumer goods, people call it inflation, but be as it may, I think it's very interesting that this individual has come up and said that resource equities or inflation protection is actually trading at a discount. We're going to go through that today. Of course, in terms of currency and money, I still favor physical gold and silver outside the system. But if you are going to have some exposure to the market, and I have some too, I think is very interesting reading. And he's written a two-page piece here that we'll go through. Before I start, though, I'd like to say, if you haven't subscribed to my channel yet, if you've just found my channel and you enjoy my videos, make sure you subscribe. Maybe tell your friends, family, and colleagues about my channel. Share my videos far and wide. It helps. And try to hit that little notification bell above if you want to be notified of all my new videos. And just a little bit of information on my videos. The reason I look at the markets here in London in the morning is because I found that the public would be interested in that, especially in the US, because that's what I used to do a lot to some of my clients that were based in the US when I was a futures and options broker in London. They always wanted to have a rundown on what was happening here in Europe when they got to the office early, let's say New York at 7 a.m. I would be telling them what was going on here. And I thought the general public might enjoy that. Some of you might not follow the markets. And that's why I do it. So who is this fund manager? Top fund manager of the last 50 years, or one of the top fund managers, of course. Well, his name is Jeremy Grantham. So he's a British investor. He's US based though, and co-founder and chief investment strategy of GMO. GMO stands for Grantham, Mayo, and Van Otterloo, a Boston-based asset management firm. GMO had more than 118 billion in assets under management as of March 2015. Jeremy Grantham, it says here, has been a vocal critic of various governmental responses to the global financial crisis from 2007 to 2010. It says Grantham started one of the world's first index funds in the early 1970s. In 2011, he was included in the 50 most influential ranking of Bloomberg Markets magazine. So we're going to go straight to his piece. This is the Focused Equity Team, June 2021, GMO, Resource Equities, Inflation Protection, trading at a discount. So I've been talking about the fact that commodities have been undervalued probably since the fall of last year, maybe a little earlier, and they're still overvalued versus equities. If you look at the CRB, even though it's risen quite a bit, relative terms to the stock market, it's still overvalued. And I think Mr. Grantham and his fund management firm has seen the same thing. So this is what this newsletter says. After decades of subdued inflation, rising prices in commodities and consumer goods have prompted many investors to revisit their portfolio's ability to withstand a rise in inflation. Yeah, it's a shame that everyone really, even the people at GMO, don't know the difference. That what we have, of course, is rising prices. They admit that, but of course, inflation has been happening ever since 1971, when Nixon closed the gold window. It just seems to me that when it seeps through into consumer goods, commodities, and consumer prices, they call it inflation. But be as it may, let's continue. Historically, resource equities have not only protected against inflation, but have actually dramatically increased purchasing power during inflationary periods. So yes, gold is money and it protects your wealth, but you can also gain from it extra. It protects you in an extra fashion. Of course, he's talking about equities, but I would also say the physical gold and silver will do that this time. In the US, we've identified 8 periods of time where inflation, as measured by CPI, was more than 5% per year for a period of 1 year or longer. In those inflationary periods, a basket of energy and metal companies kept up with or beat inflation 6 out of 8 times. So it's not perfect, but it's pretty good 6 out of 8 times. The odds are in your favor, I would say there. And again, this is not investment advice. This is just looking at what other people are thinking, looking at what I'm thinking, and maybe giving you ideas, or you have to decide for yourself, of course. And in all 8 periods, the commodity producers outperformed the S&P 500. In fact, the commodity producers delivered real returns of more than 6% per year on average during these inflationary periods, as compared to a destruction of purchasing power of around 1.6% per year for the S&P 500. So here we go. He's got some charts here. During inflationary periods, resource equities have grown purchasing power and realized returns during inflationary periods. So the first period he has is June 1st, 1933 to the 30th of April, 1935. Almost 2 years there. You can see inflation was, as per the CPI, was running at almost 5%. Energy and metals went up by more than 15%. S&P 500 probably went up by around 1%. So this is supposedly during the Great Depression, right? We're told that commodities don't do well in the Great Depression. Then you have the period here during World War II, I would say, December 1940 to end of May 1943. Inflation running at almost 10%, or CPI. Energy and metals up over 25%, and the S&P 500 running at around 12.5%. Second period, I guess, is when the troops came home, people started getting jobs. We got really high inflation, or CPI, in the post-World War II period here, from 46 to 48, over 12%. Most people think that only the 70s was a period where you had a high CPI, but it doesn't look like it. So energy and metals didn't do very well compared to the CPI, but they still beat the S&P 500, as you can see. Then there's a period of about a year in the early 50s there, where actually the metals and the stocks, S&P 500, did really well, but inflation was around 6%, it looks like there, CPI. Then the period from 68 to 70, not a great period for investors, because even energy and metals underperformed the CPI, but they outperformed the S&P 500. And here's the interesting period here. This is the 1970s period up until the early 80s. Yes, and even though gold and silver topped in 1980, it looks like the outperformance of these energy and metal companies lasted until 1982. So February 73 to July 1982, that was a pretty long period there. And I have a feeling we're entering a relatively long period, at least 3 to 4 years, I would say, more than 1 or 2. So what happened in the 70s and early 80s? Well, CPI was running at almost 9% during that period. Energy and metals gave you an almost 10% return. It wasn't really a great return relative to inflation, but that's an average. I'm sure some sectors of those energy and metals companies did a lot better. And the S&P 500 was up just under 4%. So it wasn't a great period to be in the S&P 500 at all. You did gain in nominal terms, but not in real terms. And then we've got 88 to 91, pretty good outperformance in terms of purchasing power increase by energy and metals. S&P 500 did quite well as well, but not as well as energy and metals. And then we've got beginning of 07 to July of 08. And I think we kind of saw that yesterday, actually, when we were looking how commodities, gold and silver, did during the crash that started in 07. So this is pretty clear here how commodities outperform in the beginning of the financial crisis. We had CPI running at almost 5%. We had energy and metals running at 25% return, and the S&P was negative. So there you go. So what are the conclusions here on page 2? Whether this year's price rises are merely transitory or something longer lasting, the opportunity in energy and metals companies looks very appealing from a historical perspective. Energy and metals companies are trading at a discount of over 70% to the S&P 500 index. Yeah, I've been banging on and on about this for months now, for almost a year. The biggest discount we have ever seen, with the exception of other points in the last year or so. In fact, energy companies are trading at the cheapest levels in absolute terms that we had ever seen prior to COVID. So here you go, valuation of energy and metals companies relative to the S&P 500. Yeah, we've been saying that it's the cheapest it's been over 100 years. Does this mean it's a certainty that energy and metals are gonna outperform and are gonna beat the CPI or inflation? No, but the odds are very good. I think, I'm not an investment guru, far from that, but I think it's a pretty good risk reward possibility there, or opportunity. So with prices rising, one might expect to pay a premium for inflation protection, but resource equities provide protection at a steep discount while also providing impressive diversification, the ability to capitalize on an inefficient sector of the market, and exposure to an asset class that has outperformed over the long term. So this is what value investing is about, I guess. Jeremy Grantham, I think, was a big fan of Benjamin Graham, who wrote about security analysis. I've got Benjamin Graham's kind of Bible about security analysis on my shelf here. So there you go. With that, let's look at the markets this morning, see where we are. It's 7:45 a.m. London time. So we've got spot gold has been testing that 1900 level. We've been over at 1900 overnight. Right now we're at 1897, down just about $2. The high's been 1903.60, the low 1894, pretty narrow range. Silver's down about 12 cents at 27.75. The high's been just under 28 at 27.99. The low 27.69. The Dow futures down 34. Nasdaq 100 futures up 30. S&P is up just under 2 points. To the currencies, the British pound is down about 0.15% at 141.56. The euro is unchanged, 121.80. The dollar is up 0.2% versus the yen, 109.43. Dollar is at 638.70, unchanged versus the yuan. And the Aussie dollar is picking up a little bit here, even though it's down overnight. It's almost up to 77.50. I think we were around 77.30 yesterday. WTI crude is down 0.2%, 68.67. High grade copper down 0.5% at 4.50. The 10-year yield is at 1.55, down about 2 basis points. So I think bonds are going to be a bad investment. They might give you capital gains on your principal in the short term. Over the long term, though, how can you protect your purchasing power when you're getting less than 2% in an environment where CPI or inflation could be running at 4, 5, or even 6%? So if you enjoyed this video, make sure you hit the like button. Think about subscribing to my channel if you haven't yet. And you can also follow me on all these other platforms below here. I wish you all a great day. Take care. Bye.